breaking down the absolute explosion we saw in the gold market during the first week of March 2026. Let's get right into what caused this historic move.
All right, let's dive right in, because what we witnessed was way more than just a price spike. It was a fundamental shift in how the entire market sees risk, and it was all kicked off by a world suddenly on edge.
So to really understand why gold surged, we've got to look at the geopolitical events that basically lit the fuse, changing market sentiment almost overnight.
And look how fast this all escalated. After weeks of failed talks, boom, Operation Roaring Lion hits. Iran's retaliation was incredibly swift, and the result was the functional shutdown of the Strait of Hormuz, a massive choke point for global trade. With about a fifth of the world's oil supply suddenly at risk, you can bet shockwaves ripped through the markets.
You see, this wasn't just a momentary panic. The market's reaction tells us it's gearing up for a sustained conflict. It's like a complete regime change in how global risk is priced, shifting from short-term jitters to long-term, deep-seated uncertainty.
Now let's see how this geopolitical firestorm ignited one of the most dramatic price moves in gold's recent memory. I mean, when markets opened on Monday, March 2nd, the panic was real. Investors were scrambling for the ultimate safe haven asset, and you guessed it, all eyes turned to gold. Gold didn't just climb, it absolutely shattered its all-time high, rocketing to an incredible $5,361 an ounce. It was a truly historic trading session. What's so striking here is the sheer speed of this move. A 2.16% jump in a single day, that's a pure flight to safety. The close above the $5,200 pivot point was the real kicker. That's a critical technical and psychological level traders were watching, and it basically acted as the launchpad for this explosive rally. And this just highlights how unique this situation really was. Gold broke its usual inverse relationship with treasury yields, which almost never happens. That tells you investors were prioritizing the return of their capital over the return on their capital. This wasn't a broad commodity boom. It was a targeted, all-out rush for gold as the ultimate geopolitical insurance policy.
Okay, so with gold at record highs, the big question on everyone's mind is, how high can it go? Let's explore the bull case, which some analysts are calling a Wave 5 impulse. That's a term from Elliott wave theory, suggesting we're in the final and often most powerful upward leg of a major trend.
Analysts are pointing to this perfect storm. You've got geopolitical fear, you've got central banks continuing their buying spree, and you have the market expecting looser monetary policy. This combination could set a whole new, much higher floor for gold. If the bulls can maintain what's called vertical momentum, a sharp price jump on high volume, the path to more gains looks wide open. And as you can see here, major institutions and technical models are all pointing to some pretty significant upside. A sustained break above 5,500 could kick off the next major rally, with primary targets around 5,540, then 5,700, and some calls even going well past the $6,000 psychological mark.
But hold on, not everyone is convinced. Some analysts are sounding the alarm, warning of a potential bull trap, a sharp reversal that could catch overly optimistic investors completely off guard.
So the bear case basically boils down to this. The move was too much, too fast, and it's just not sustainable. Historically, as gold approaches key Fibonacci levels, think of them as historical challenge zones, it often gets hit with heavy selling pressure. The concern is that the current wave of panic buying has already exhausted itself. Now, if gold fails to break higher and instead drops below that key support around $5,217, the bears are looking for a deep ABC correction that's a classic three-wave decline. In that scenario, gold could fall back down to fill what are called liquidity zones around 4,700 or even as low as 4,400, which would completely invalidate the bullish setup for now. And this right here highlights a key risk. Just before the recent conflict blew up, some analysts actually spotted this exact reversal pattern forming. That might suggest there was already some weakness under the surface, and this big surge could have been the final exhaustive push before a serious downturn.
So let's put it all together. What's the main takeaway from this historic week for gold, and where is the market headed from here?
The market is truly at a crossroads. It's a classic tug-of-war between the powerful, emotional driver of global fear and some very real technical and fundamental headwinds. These are the key signals analysts are watching to figure out if we're in a breakout or a bull trap. Many are expecting a gap up at the market open, and the strategy is to wait for a pullback. As long as that pullback stays above the $5,250 level, it would be seen as a strong vote of confidence for the bull case. At the end of the day, breaking through $5,300 is more than just a headline. It's a clear signal that the world is confronting a new level of uncertainty, and gold is the primary way we're all measuring that anxiety.
It's a provocative question, and honestly, the answer is probably going to define this market for months to come. Trading is all about probabilities. So what's your scenario for gold this week? Thanks for watching, and we'll see you in the next explainer.